Welcome everyone to Vested Interest. This is Shane. And before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers a dividend, and companies with a high return on their invested capital. I utilize both a dollar cost average approach as well as dumping large chunks of money into the portfolio whenever I get a bonus or if I do a side job, something like that. I cover all of my investments into the portfolio on the channel. I do not have a paid Patreon account. I don't intend to have one. We all have enough to pay for. There are no other paid sites that I send you to or paid paywalls or anything like that. I'm not trying to sell you any courses, nothing like that. It is free to see what I am doing. On this video, we are going to take a look at the 4 stocks I'm looking to focus on in June. As you can see here, Realty Income, Comcast, CVS, and Starbucks. There are some others we'll cover at the end that I think are showing some value right now that I might mix in as well over the next month. But these will really be the 4 that get the bulk of the focus of my capital investing this week, or this month, in June, as well as the 2 ETFs that I buy weekly regardless of what the market looks like, and I'm going to continue to do that going forward. Now, before we get into the video, if you would help me out by hitting that thumbs up button down below if you find any value in the content, make sure you subscribe to the channel, hit that subscribe button, join us on this journey to financial freedom, join the Vested Interest community, hit the notification bell so you're notified whenever we put out any new content. I do these once a month here as we go into a new month. I look at the stocks I'm looking to buy. I do a stock pick of the day series Monday through Thursday where we look at a stock that's pulled back on the day. Sometimes I'll do requests from subscribers on companies they want me to look at. So go ahead and drop those down below in the comment section as well. I also do a portfolio update every Sunday morning at 7:30 a.m. So again, make sure that notification bell is rung. Hit that notification bell so you're notified whenever we put out any new content. Share the videos with anyone who is a dividend growth investor out there that you know, or investor in general out there that you know that might find value in the content. And with that said, let's jump in and look at these 4 stocks that I'm looking to buy here and some of the metrics around them, and the 2 ETFs as well. Many of you, if you've been watching the channel, know exactly what those are, but we'll cover them as well. And first up, we are going to continue to focus on Starbucks. This is our most recent addition to the portfolio, and well, it's been a little over a month and a half now we've been adding to this position. Once it dropped under $80 per share, we really started adding here. So we are talking about Starbucks Corporation, ticker SBUX, out of the consumer discretionary sector. And overall, right now, the consumer discretionary sector, along with a couple other ones, REITs, for example, the healthcare sector, and you're going to see some of those companies that we're looking at today, including Starbucks, are in those sectors. I feel like those sectors right now have really pulled back overall. So it's not just the companies I'm looking at, focusing on. These are the ones I've picked. But there are other companies in those sectors that have also pulled back. So it might be time to look at some sectors right now. It seems like there's a little bit of a rotation out of some sectors into others. And those are the times whenever companies start to show some value, at least in my opinion. So for this one, we're going to look at Starbucks, ticker SBUX, out of the consumer discretionary sector. All of these numbers will be as of the close of business on Friday. Closed out the day at $80.22. Looks like it was down a little bit in the after hours. The 52-week range as low as $71.80, as high as $107.66. So even though it has started to recover a little bit, it is still closer to its 52-week low than its 52-week high. EPS is sitting at 3.63, so $3.63 per share. PE ratio, little high. This is about what the market is right now, 21, 22. PE ratio 22.10, $22.10 per share. Forward PE a little lower than that, which I like that. I'd like it to be back down in the 15, 16, 17 range, but I'll take it in the teens here, a 19.51, $19.51 per share. Does have a $2.28 dividend. That is the annual payment. They are a quarterly payer, so divide by 4. A nice starting dividend yield of 2.84%. A beta of 0.97, so it is less volatile than the overall market, but just slightly. Analysts call it a buy. They have a price target of $97.15, which speaks to some upside as far as price appreciation in the stock price. 21.1% appreciation at that. Earnings date was July 30th. Ex-dividend date May 16th. So tune in for the earnings date if you're interested in that. And that ex-dividend date has passed, and they did pay out last day of the month there on May 31st. So yesterday they did pay out the dividend I'll have to check my bank. I think I did get the dividend in my bank already. So kudos to all of you out there who are Starbucks investors who receive that dividend payout. Now let's take a look at dividend yield theory to see if this one is potentially undervalued. To do that, we look at their 5-year dividend yield average of 1.95%. We compare it to its current 2.89, or over here 2.84. They're a little off, but they're calling 2.84 the trailing. Either way, 2.89 right there close, because this chart is actually from stockanalysis.com and the dividends and splits section is actually from Yahoo Finance. So those are the two sites that I'm looking at. So the numbers aren't quite exactly the same, a little off here. But since this is higher, their forward annual dividend yield or current annual dividend yield is higher than their 5-year dividend yield average, that speaks to undervaluation, at least according to dividend yield theory. Now, payout ratio is 60.61%. I like 75% or under. And if you tune into my Stock Pick of the Day series, you will see my investing criteria, my initial screener. And that's whenever I say I like some of these numbers, that's what I'm looking for. Under 75% for payout ratio. Dividend yield theory, I always take a look at that on that same one. So we run through a lot of these numbers in that video, Stock Pick of the Day series, and that's where I pulled this information from. So payout ratio under 75%, which is what I'm looking for, 60.61%. So it gives them room to continue to increase those dividends over time, pay down debt, make acquisitions, buy back shares, all the things companies do with free cash flow. Now, as you can see here, return on equity and return on invested capital, I like 10% or better for these numbers. Now, return on equity for this one looks very bad, negative 49.8%. But if you look at companies like Starbucks who have to continually open new stores or have their own stores and have some real estate, this is pretty typical. For whatever reason, their return on equity, and I'm assuming that's because they're constantly opening stores, dumping money into new locations, or revamping those locations, doing upgrades or repainting or new layouts, whatever they're doing. They're always dumping capital into them. So it tends to skew these return on equity because you don't get a very good return on a lot of those. If you go in and remodel a store, for example, you're not getting a return on your investment for 2, 3, 4, 5 years down the road. So as they open new stores and try to continue to expand, I'm going to say these return on equity numbers are going to continue to be negative. I don't like it, but it is just the nature of the business. But their return on invested capital is very good, 25.46. So that's what I look at here for a company like this. They're getting a good return. Their return on equity initially is bad, like I said, negative 49%, but their long-term return on invested capital is good, 25.46, and I look for 10% or better. EPS growth, I like 5% or better projected. They're projecting out 12.45% over the next 5 years with revenue growth of 7.73%. Good numbers overall. We're going to take a look at free cash flow here real quick. Going back to 2020, and we want growing free cash flow because typically if a company has growing free cash flow, they have growing dividends to go along with it. Going back to 2020, you can see here 114 million. 2021, huge jump up, 4.5 billion. 2022, 2.5 billion. So it looks like a bit of a drop. 2023 back up to 3.6 billion. You can also see they're repurchasing shares here. 2020, 1.6 billion. 2022, 4 billion. 2023, 984 million. So even though it looks like there was a drop in 2021, that can be more than accounted for with the repurchase of their own shares here, as well as what looks like they even raised, they continued to repurchase shares and still grew their free cash flow in 2023. So I like the numbers overall. The projections have slowed down a little bit, but that's all right. This is a pretty well-established company. I expect companies, as they get built out and grow over time, they will slow down with their growth. That's just the nature of business in general. Now you can see here my Starbucks position. I do have 56.288 shares. My cost basis is $78.74, so I am up slightly. I would like this to stay down in the 70s while I build this up, but I am willing to buy it into the mid, I think it's $85, $86 range, might even be 88. So long as it stays within 15% of their 52-week low, I'll continue to build this out. I want to try to get this to 100 shares. So even if it goes a little bit above 15% of its 52-week low, which I think is above $88, I would probably still add up to 100 shares so long as my cost basis here stayed under $85, $86 per share. That's where I'd like to keep it. So that's number one on the list, Starbucks. Next one on our list, number 2 here, Comcast Corporation, ticker CMCSA, out of the communications sector, closed out the day at $40.03, or closed out the trading week at $40.03. 39.62 in the after hours, looks like another one down in the after hours slightly. 52-week range as low as $36.43, as high as $47.46. They are closer to their 52-week low than their 52-week high. I'd like them to stay under 40 while I continue to build this one out. Now, I do have a nice position in this one, but another one I want to continue to build out a little bit here. EPS, $3.78 per share. Price to earnings, current $10.59 per share. Very low, even lower forward PE at $9.10 per share. Dividend is $1.24 on the year. They are quarterly payers, so divide that by 4. Nice starting dividend yield of 3.1%. 52-week range, $36.43. I said that a minute ago. Beta of 0.99. Less volatile than the overall market, but just slightly so. The market being 1. Analysts call it a buy. Price target of $48.68 with a potential 21.61% upside in the price appreciation here. Earnings date, July 25th. Ex-dividend date coming up July 3rd. Looks like they're going to pay out in July 24th. We're going to take a look at dividend yield theory. To do that, we look at their 5-year dividend yield average, 2.26, compare it to their current 3.19. So that speaks to undervaluation again, at least according to dividend yield theory. Payout ratio very low on this one, 31.3%. Gives them a lot of room to continue to grow this dividend, pay down debt, make acquisitions, build out their infrastructure. This is Comcast is one of the companies that's going to be impacted by the Infrastructure Act as they build out more infrastructure here and add more lines to more people, especially out in the rural areas where a lot of people don't have internet access or good internet access. Comcast will continue to grow in those areas. Obviously, they're pretty well built out in the cities, but some of those out in the country will benefit from that type of legislation. So this is one I expect to continue to grow, even though it may be slow growth. I expect it to continue to grow as more people get access to the internet and cable. I mean, this would be folks like my parents who haven't been able to get cable until recently. They are the type of people I'm talking about. They live out in the country, so that's how I know. I kind of joke with my parents that whenever I come to their house to visit, I kind of know where the country is overall, because as they get more and more technology out there, it tells me that it's spreading across the country a little more. Like I said, those of us who live in the city or closer to the cities, we know what we have. That doesn't necessarily always translate out into the countryside, but that's a different conversation. But anyways, payout ratio again low, 31.3%, so they have a lot of room to continue to increase that. Return on equity sitting at 18.60. I like 10% or better, so very good number there. Return on invested capital 9.79, just under the 10% I'm looking for. EPS growth forecasted at 10.82%, much higher than the 5% I'm looking for, with revenue growth, slow revenue growth here, 2.03, but it is growing. Jumping over, looking at their free cash flow, going back to 2020, you can see $13 billion, 2021, $17 billion. Looks like a bit of a drop in 2022 at 12.6, growing again in 2023 at 12.9. But if you look at the repurchase of shares, $534 million in 2020, $4.6 billion in 2021, and then a huge jump up. Even though it looks like they dropped in free cash flow in 2022, that can be more than accounted for with this increase in their repurchase of capital shares, as well as same thing in 2023. Big repurchase in 2023 here. So I like that they're pulling a lot of shares, especially the last couple of years, out of the market, and I hope that they continue to do so. Again, another one, I have a very well built out position here. I would like to get this over 200 shares. Not that I want to do it over the next month, but slowly here over the next several. I will probably continue to nibble. I'd like it back in the 30 range, but so long as it stays under 42 per share, I will probably continue to add to this. 130.775 shares currently. Cost basis of $41.76. So I am up slightly. Actually, no, I'm down a little bit, down 4.15%. So I want to continue to bring this cost basis down. They're currently under my cost basis. So again, as long as it stays under 42, I'll continue to add to this one. And I'd like to get this to about 200 shares. So that's number 2 on our list. Number 3 on our list, Realty Income. This is the monthly paying REIT, ticker O, out of the REIT and real estate sector here. Closed out the week at $53.06. Looks like they were up a little bit in the after hours. I actually added a couple of shares this week at $51. Tune into the portfolio update tomorrow morning. You'll see the rest of my buys. But I did add to this position this week and will continue to do so. I like this one. I think my cost basis, we'll see it down here, $58. So I'm looking for anything under 58, and I'll continue to add. 52-week range as low as $45.04, as high as $64.18. So even though they've recovered a bit, they've been floating here in this 51 to 55 range for a while now. They are still closer to their 52-week low than their 52-week high. EPS $1.08 per share. PE looks extremely high at $49.13 per share. Even the forward PE at $33.96 looks extremely high. But for this company, you want to look at funds from operations versus price to earnings. That's not a very good metric for REITs. Dividend is $3.15. This one you divide by 12 because they are a monthly payer. Very, very nice starting dividend yield, 5.94%. Beta of 0.92, so another one that's just, excuse me, slightly less volatile than the overall market. Analysts call it a consensus buy. Price target of $60.39 with a potential 13.82% upside. Earnings date coming up May 6th, or just passed last month in May 6th, so you can go ahead and check out their website to see if you want to read that. Ex-dividend coming up June 3rd, I believe that's Monday, and they are going to pay out June 14th. Taking a look at dividend yield theory, we look at their 5-year dividend yield average of 4.58%, current 5.81. It's actually, they call it 5.94. These numbers are slightly different again because this chart is from stockanalysis.com. This part is from Yahoo Finance. And that's why I recommend more than one source. They're not always actually aligned. Some of them don't update as quickly as others, so I always recommend more than one source. You pick any sources that you like, just don't blindly follow and believe one is accurate. So according to dividend yield theory, potentially undervalued. Payout ratio looks extremely high, 284.35%. REITs, again, you want to look at funds from operations, and REITs in general pay more payout ratio or a higher payout ratio. They're required by law to pay 90% plus of their free cash flow in dividends. It's just what they have to do to maintain their status as a REIT and get some of the benefits, tax benefits of that. Return on equity and return on invested capital are going to look very low on these. All REITs do. Return on equity sitting at 2.3%. Return on invested capital 2.39. If this was not a REIT, I'd be concerned with that. For this company, I'm not. EPS growth forecasted at 9.33, much higher than the 5% I'm looking for. Looking at free cash flow, going back to 2020, you can see here 1.1 billion. 2021, 1.3. 2022, 2.5. 2023, 2.9. Nice, steady free cash flow growth. I like to see that. And another one, I have a pretty well-established position here, but another one I don't mind building out. I love the 5+% dividend yield, almost 6% dividend yield here. So I'm going to continue to bring my cost basis down. I am down a little bit on this one, 248.927 shares, $58.18 per share is my cost basis, down 8.8%. So another one I want to continue to bring my cost basis down, bring up my dividend yield on this one and potential future returns. So that's number 3, realty income out of the real estate sector. And last, but certainly not least, excuse me. Sorry, my sinuses are really killing me this right now with all the flowers and the trees blooming. CVS Health Corporation, ticker CVS, out of the healthcare sector, closed out the week at $59.60. Another one down a little bit in the after hours. 52-week range as low as $52.77, as high as $83.25. So another one that's up against its 52-week low. EPS, $5.70 per share. Price to earnings ratio, $10.46 per share. Very low. Even lower forward PE, $7.47 per share. I really like this in the single digits. Dividend, $2.66 per year. Divide by 4, it is a quarterly payer. Nice starting dividend yield, 4.46% on this one. Beta of 0.55, so it is less volatile than the overall market. Analysts call it a consensus buy. They have a price target of $76.10 with a potential 27.69% upside. Earnings date was May 1st. Go ahead and check out their website if you're looking for that. Ex-dividend date was April. They paid out on May 1st. So if you were to buy them now, you'd have to wait a couple months to get the next dividend. Dividend yield theory, looking at that, we look at their 2.87% 5-year average. We compare it to a current 4.46%. Dividend yield theory says it's potentially undervalued, 4.46% being higher than their 2.87% 5-year average. So not only higher, but a significant margin of safety, at least according to dividend yield theory. Return on invested capital and return on equity on this one. ROE is a little low, 9.8%, and return on invested capital, same thing, a little lower than I'd like it at 6%. They've done a lot of acquisitions over the last couple of years, so I am waiting for, and knowing that, I'm all right with these numbers because, again, whenever you make acquisitions like that, typically, whether you like it or not, companies tend to overpay a little bit, and those return on their investments do not pay off for 3, 4, 5 years down the road. So I'm looking at these numbers, wanting them to get better over the next several years, and I expect them to do so. Now, if that doesn't pan out, 3 years from now, maybe we'll reevaluate CVS. But for right now, I see value here. I'm going to continue to add here. EPS growth, very high double-digit EPS growth at 11.92%. I like 5% or better. And nice revenue forecast at 5.4%. For a company this size, I like that forecast. Now we'll have to see if they actually meet that. That'd be the key. Going back to 2020 for free cash flow, you can see 13.4 billion, 2021 15.7, 2022 13.4, 2023 a bit of a drop down to 10.3. Repurchase of shares, they started in 2022. So again, 2021, even though it looks like it dropped in free cash flow down to from 15.7 to 13.4, it's more than accounted for here in the share repurchase of shares here. It is not, however, accounted for a drop from 2022 13.5 down to 2023. So 2023 is a bit of a drop because they dropped down the repurchase of shares as well. So I'm hoping that 2024 they get back online. Now, full disclosure, I do work for an insurance company. CVS does have an insurance arm, and I know that because of a lot of the Medicare payments, some of the stuff that happened around COVID-19 there, that has impacted insurance companies. It's impacted my company. So I believe that some of this impact in 2023 is from their insurance arm. That's just me projecting based on what I know the industry I work in. CVS, another one in my portfolio. I do have 184.041 shares. My cost base is $67.71. I am down 11.98%. I want to continue to add to this, bring my cost basis down, bring up my dividend yield, and bring up my potential future returns. Now on to the two ETFs, and I've been adding these all year, every week, regardless of the price. I'm going to continue to do so into the future. We are talking about Schwab U.S. Dividend Equity ETF, ticker SCHD. I know a lot of people out there in the dividend community are well aware of this one and probably already in your portfolio. So I'm going to continue to add to this one share a week at least. If it was to pull back into the mid or low 70s or even high 60s where I was buying it in my daughter's accounts last year, I will look to add even more. But right now, just one share a week is what I'm looking for. $78.57 is what it closed out the week at. And we're going to run through the assets under management, $54.27 billion. Low expense ratio for ETFs. Index funds, you want a very low expense ratio. This is 0.06%. That's pretty low. PE ratio 14.9. That's the average of all of the positions in the portfolio. Shares outstanding, we're not really concerned with that. Dividend yield is 3.4%. Nice starting dividend yield. Ex-dividend date March 20th. I believe they are going to pay in June, I believe. Payout ratio of 50.68%. 1 year return 12.9%. I'm not really worried about that. 52-week low, $66.67. I was buying them back in the 60s in my daughter's accounts. 52-week high, $80.82. So it is closer to its 52-week high, but again, that doesn't really matter to me. I'm going to continue to buy. Now, as you can see here, I pulled up the top, I believe this, top 15 holdings here. Texas Instrument, Amgen, Lockheed Martin, Chevron, Pfizer, PepsiCo, the Coca-Cola Company, Verizon, Cisco, BlackRock, United Parcel Service, AbbVie, the Home Depot, Altria Group, Bristol Myers Squibb are the top 15 holdings. You can go ahead and look at the rest of them. Here's the weightings on the side. Go ahead and pause it if you aren't interested in that. I do currently have 23.084 shares. My cost base is $77.75 per share. I am up slightly. That is SCHD. And to wrap up the video, same thing, Vanguard Total Stock Market, ticker VTI. We've been adding one share per week. We're going to continue to do so. I'd love for the total stock market to pull back. That would mean the other positions in my portfolio have probably pulled back, and I could get this one cheaper. But it doesn't matter what it is. I'm going to continue to add one share per week. Again, assets under management, $393.95 billion. Expense ratio, a little bit lower than what we saw with SCHD at 0.03%, very low. PE ratio, 24.49 currently. So that's the market, right? 24.49 PE ratio, which is actually pretty high for the market. You really want the market to be around 18 or so. 18 to 20, I would say, would be a more fairly valued market. Right now, it seems a little bit highly valued. A lot of that is because tech has really run up. So maybe we'll see a tech pullback. Who knows? Not worried about shares outstanding. Dividend yield 1.36%. Very low dividend yield on this. You're not buying this for the dividend yield. You're buying for a bit of stability and to be in the overall market and for price appreciation over time really is what you're looking for with this type of ETF, though it does, kick out a small dividend yield. So there is that. Payout ratio 33.26. 1 year return currently 25.71%. That's what you're looking for, right? You're looking for the average return of the market. That's why you're into a ETF like this. 52-week low, $202.44. Love it to pull back here. I could add a significant portion if it did. 52-week high, $263.92 again, right up against its 52-week high, but we're going to continue to add at least one share per week. If it was to pull back significantly, we would look to add more. Beta of 1.03, the market being 1, so it is a little funny that they are slightly over the overall market, 1.03, but that is what it is. Holdings, 3,721 holdings. That's just basically every stock in the United States stock market. Again, pulled up the top 15 holdings here. Microsoft being number 1, Apple, Nvidia, Amazon, Alphabet, Meta, Alphabet. So you've got the Google, GOOGL shares and the GOOG shares. Berkshire Hathaway, I think they also, if you were to go further down past Berkshire Hathaway, also has their B and there's A shares. Eli Lilly, Broadcom, JP Morgan, Tesla, ExxonMobil, United Health Group, Visa. So if you own an ETF like this, you're going to own non-paying dividend stocks as well. Like I said, it's just all the companies in the market, whether they pay a dividend or not, whereas SCHD is more focused on dividend growth. So currently, 22.039 shares. My cost base is $251.40. I am up slightly, 3.6%, but I'm going to continue to add. Doesn't matter what the price is. I'd love it to drop back. I'd love the overall market to drop. Everyone would probably freak out. We're in a recession. Things are going, to fall apart, but that is the market. I love stocks at their 52-week low. I'd love the market at its 52-week low. I just add a little bit more capital. Whenever I go into a store and see a sale, I don't run away. The stock market to me is no different. Whenever I see red, that means it's time to buy. So long as the company I'm looking to buy, the fundamentals of the company haven't changed and it's just pulling back because maybe the overall market's pulling back, maybe the sector it's in is pulling back, or maybe there's been some negative news, short-term news that's impacted the price. Those are the times I look to buy, again, so long as the fundamentals of the company are the same. So those are the 4 companies I'm looking to buy and the 2 ETFs I'm going to continue to buy for the month of June and the ETFs for the entire year and probably going forward into the future. But these are some other companies I see some value in as well. You're going to notice some sectors here, right? Pfizer and Johnson & Johnson being out of the healthcare sector. That's one that I see some value in. Haverty's Furniture being out of the consumer discretionary sector. That sector in general I'm seeing some value in. Cisco has pulled back. Like to continue to add there. A lot of other tech companies are still running, but Cisco has pulled back. Verizon out of the communication sector. You saw Comcast was on my list as well. So there's a couple in the communication sector that have pulled back. Valet out of the materials sector and Enbridge out of the energy sector. These are some other ones in my portfolio that I'm seeing some value. I will probably nibble on these over the next month where I see value, where I see a nice pullback on maybe the week that I'm looking to invest in. But I'm not looking to dump a significant amount into any one of these positions. It will just be based on where they sit at that week whenever I dump money into the market. Let me know if there's some other companies you think are showing some value or what sectors you might be seeing value. I'd be interested to hear from you down below. Let me know what you're going to focus on for the month of June. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And let me know, have you started your investing journey? And if you haven't, tell me why not. I'd love to know why you're not investing in the stock market for yours and your family's future. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes with those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing during educational and entertainment purposes. Investing involves risk and kind of money. To never invest any amount not pleasing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.